Good morning, everyone, and welcome to Julius Baer's Moving Markets podcast. It's Thursday, the 5th of March, and my name is Helen. Filling us in on the latest in financial markets today, I'll be speaking first of all to Mike Rauber. And then, as we've seen big moves in energy markets this week, it'll be great to catch up with Norbert Rücker as well, who has an update on oil and gas for us this morning. So that's coming up in a few minutes, but over to you, first of all, Mike, for the market news. Good morning.
Good morning, Helen.
US and European equities had a strong day yesterday, although it still felt a bit like investors were waiting for clearer signals in terms of the war.
Yeah, it was really a low conviction advance, it seemed. So, despite continued conflict, including reports that a US submarine sank an Iranian warship in the Indian Ocean, investor sentiment improved, mainly because oil prices, the market's key war barometer, held steady. President Trump and the Treasury Secretary said the US would support oil tankers in the Persian Gulf, although shipping groups said they needed more details. This morning, Brent is a little higher again, trading near $85 a barrel, close to Tuesday's high.
The absence of another sharp spike in energy prices helped European markets recover part of the 4.6% loss they saw at the start of the week. That was the biggest two-day drop since April. So the Euro Stoxx 600 gained 1.4% yesterday.
Yeah, strength was broad across sectors, or just a reversal after 2 days of heavy losses, as you said, with most industries rising. Also helping sentiment, Eurozone unemployment fell in January to 6.1%. That's a record low for the Eurozone bloc. But inflation, it climbed to 1.9% in February. That's even before the Middle East conflict pushed gas and oil prices higher, as we know.
And over in the US, economic data eased growth concerns and reduced market expectations for a rate cut in July.
Absolutely, Helen. So US companies added 63,000 jobs last month. That's the strongest increase since July, according to payroll firm's ADP. And the ISM Services Index reached 56.1. Now that's signaling the fastest expansion since mid-2022. Now, against that backdrop, the S&P 500 gained 0.7% and closed above its 100-day moving average, while the more cyclical small-cap Russell 2000 rose nearly 1%. The VIX index, Wall Street's fear gauge, dropped to 21 points. This is clearly not signaling any investor panic.
Besides cyclicals, technology stocks drove much of the US gains. And after the close, we had Broadcom reporting results.
Yeah, so the company slightly beat fiscal Q1 expectation, and it expects AI chip sales to top 100 billion in the near future. That's an annual figure. The company also announced $10 billion in share buybacks, or so the shares were 3% higher in after-hours trading.
What about currencies and precious metals yesterday? How did they do?
The dollar is holding firm near a 3-month high. Gold has remained steady over the past 2 days, trading between $5,100 and $5,200 an ounce.
And let's talk a bit more specifically about the euro and the Swiss franc. What's driving the recent moves in these currencies?
So investors have turned more bearish on the euro as the Middle East conflict increases the risk of persistently higher energy prices. Now, options markets show the most negative positioning towards the euro in a year. That's a sharp reversal from 6 weeks ago when there were more bullish waivers. Now, the Swiss National Bank made clear this week that it is ready to intervene. The sharp rise of the Swiss franc, especially against the euro, prompted warnings on Monday and again yesterday. Having to step in twice underlines how challenging the situation is. Euro Swiss franc around 0.90 looks like the line in the sand.
And with the improved market sentiment, Bitcoin climbed 8% to a 1-month high, moving above $72,000.
Yeah, so it gained support after a report that President Trump met the CEO of Coinbase, and later the US president urged the passage of the long-debated Clarity Act, a key step towards establishing a clearer regulatory framework for the US crypto industry.
Now, China's closely watched National People's Congress is underway with a host of announcements and plans. What can you tell us on this, Mike?
There's a lot of information trickling out as we record this, but China is set its GDP target for this year to a range of 4.5 to 5%. Now, that's the lowest since 1991 and clearly signaled a shift towards rebalancing the economy and boosting consumption, which investors welcomed initially. Premier Li also highlighted the challenges of moving to new growth drivers, citing weak demand, soft market expectations, and rising risks in key areas. Now, Chinese stocks are just slightly up. Technology stocks in Hong Kong are under pressure after head of Alibaba's Quen artificial intelligence division said that he would resign.
The region overall seems to have followed Wall Street, though, just a day after South Korea posted a record one-day drop of 12%.
A huge move, but the risk on sentiment returned in a vengeance in South Korea. The Kospi index is up 10% today. Now, that's its biggest daily gain since 2008. And now that one can call high volatility. In any case, this lifts the broader MSCI Asia Pacific Index nearly 3%, the first increase in 4 sessions. In Japan, the Nikkei 225 is up over 2%.
All right. And just lastly, what are we expecting today, Mike? What's coming up?
Of course, the war is the big focus for market themes and what's happening in the energy market. Now, in economic data releases, we expect Eurozone retail sales for January and French industrial output also for January later this morning. And in the US, we get weekly job claims data and Q4 productivity figures. And finally, just taking a look at the futures board, I see that European equity futures are expected to open slightly in the red.
All right. Very good. Thank you very much, Mike, for the great roundup this morning.
Thanks a lot for having me, Helen.
And now on to you, Norbert. Good morning, firstly. Welcome.
Good morning, Helen.
So on to energy markets, which are continuing to struggle with the conflict in the Middle East. There's just so much uncertainty. What are the things you are observing closely?
Our focus is really on the energy infrastructure, the oil and gas infrastructure in the region, and if there's meaningful damage. That doesn't seem to be the case yet. Further, there seems to be some weakening of Iran's military strength, and it's just the case that also the defense capabilities are very strong. That said, and that's important, that dynamics are changing somewhat because the supply disruption so far is mainly about the choked trade. So ships avoiding the Strait of Hormuz for precautionary reasons, which means that oil and gas is piling up on either end. And this cannot go on for long because eventually you're running out of storage, you're running out of ships because everything is stuck in the Persian Gulf. And this logjam has already begun to incrementally turn into something different, a different type of supply disruption, which is basically production shut-ins. We had some first prominent examples of that, the large Rumaila oil field in Iraq, and also the much discussed Qatar natural gas liquefaction facility, which has been shutting down, not because of damage, but exactly because they're running out of storage to store the gas. We expect there will be more of this kind of news flow, and that should really continue to support and lift supply fears in the market.
As production shut-ins could incrementally pick up, how serious do you think such a supply disruption could be?
Yeah, of course, everyone is doing the math a bit on that now. And if you assume there's kind of a 50% shut-in rate for some days, the resulting loss of barrels could, to be honest, be easily absorbed by the market. That loss would not reduce basically the supply in the market, but would only take away some of the surplus that we have seen building up over the previous month. What helps in the case of oil is that there are alternative supply routes. There are pipelines towards the Red Sea, there are pipelines towards the Indian Ocean that keep the oil partially flowing out of the Middle East for the time being.
And how is the natural gas market dealing with the outage of Qatari supplies?
Yeah, the situation there is different. That's maybe also why gas prices reacted somewhat more emotionally over the past days, even though they've been coming down now yesterday, because there's really no alternative to circumvent the Strait of Hormuz. However, there is something else, another dynamic in the natural gas market, because demand is now dropping meaningfully as the winter heating season basically is ebbing, which significantly lowers the immediate supply threat, because what this disruption now does, it simply delays the filling up of storage. It does no longer empty storage. On top, the gas market has great flexibility. We believe that at least half of the disruption, should it be a more lasting one, could be offset by more production coming from North America, just squeezing out more of the existing terminals, and also because new terminals are starting. And the other half could be compensated by the flexibility on the demand side, basically by, for example, power plants no longer burning gas, but instead shifting to coal. And that's exactly what the gas market already with current prices is incentivizing.
Do we need to worry about any meaningful economic consequences, do you think?
No, we stick to our view that the consequences of that should be negligible. Oil trading somewhere in the 80s does not drain consumers' household budgets at the pump. Equally, natural gas trading around or above €50 does not result in a meaningful cost push either. Remember that more or less a year ago, natural gas traded at higher levels. They topped at the time above €60 without causing any economic consequence for Europe. And moreover, there's a very important aspect, because for natural gas, what matters is kind of the transmission, or how this cost push then gets amplified by the electricity market. This transmission seems to be broken, at least now seasonally. Why is that? Because we're in a period where there's lots of renewable generation, which means natural gas power plants are less called upon, they're less in use, which means that the cost spike unleashed in the Middle East is partially broken before hitting industrial users or households. So in a nutshell, our base case remains the one of a short-lived, intense spike in energy prices, more or less topping around the current levels, maybe slightly higher. And key to our view there is the absence of serious infrastructure damage. But key to our view is also that we believe that there could be soon a solution found to unclog the trade around Hormuz by safeguarding the shipping. That's it from energy markets.
Excellent. Thanks a lot, Norbert. Really good to hear your latest thoughts on this today. Thanks for joining me.
Thanks.
So that's it for today. Thank you again to Mike and Norbert, and to you, our listeners, for tuning in. I hope you enjoyed the show. If you did, then make sure you subscribe if you haven't already. And please join us again tomorrow, when I'll be back with more of my colleagues to talk about what is moving markets. Until then, though, have a great day, everyone, and bye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.